But here we are for another water cooler conversation, joined by Luke and Kevin Holleron. Kevin Holleron runs a wealth management firm, Holleron Wealth Management, and has been helping dentists over the last 15 years in various exit strategy planning, both from a pre-sale point of view, post-sale, but obviously the longer the planning, the better. Kevin's here to join us today to offer some words of wisdom and hopefully give you some good advice in terms of how you can plan for the future. And we've got a very short space of time, but hopefully a couple of good questions that Kevin can answer. So
should we start with the budget? Because obviously the budget was where we kind of started. We left off last week, which obviously had some interesting developments in it. So has the budget made a big impact to kind of what you're looking at and thinking about, Kevin?
Yes, I mean, thanks first of all having me on. It's been, I've been looking forward to talking about all things financial and dental, and obviously the budget is, huge implications, and obviously a big budget with it being related to COVID. And I think one of the kind of the changes that happen that is affecting dentists already is the change in the lifetime allowance for pensions, because ironically, with the corporation tax increase to 25% in 2026, ironically, one of the best ways of reducing corporation tax is using pension plans. Unfortunately, because lifetime allowance has been capped at 1,073,000, it means that there's less sort of headroom to invest into a pension scheme. And that might sound like a huge number, but I mean, the numbers are that because that's now been capped to 1,073,000, by 2026, it would have been more like, it's about 1.24 million. So the difference is, what it means is that that simple change in the budget means it will cost dentists around about £93,000 if they were one of those dentists that were aiming to get to the lifetime allowance. And an example would be, someone that's got a dentist that's got a freehold within a SIP, so they can't turn the rental income off. That's income that's going to go into the pension and build the funds. And if we're not careful, we sort of go over those limits and it becomes really prohibitively expensive. So perhaps not everyone's aware that that's how it will affect them. So it's important just to make sure you're aware of it and take strategies to mitigate, where possible. I think obviously it also leads into the corporation tax issue again, because the pension allowance can reduce corp tax, and we know that that's been tiered to go from sort of 19% to 26% once you're above the 250k net profit figure. So again, a lump sum pension contribution can get you below the 250, and that will save you, it will take from 26 down to a lower rate of corporation tax. So again, that's another pretty popular topic this week. Only 1 week after the budget, the meetings we've had this week have been revolved very much around those sort of strategies.
Okay, and in terms of when you're working with clients, in that respect, is it? I suppose the longer the planning, the better. In that, from their point of view and from your point of view, I suppose, because it allows you to get a stronger understanding in terms of what it is that they've got and how you can help them.
Yeah, definitely. I mean, that's the key is longevity. So having, I always sort of start with the mantra, begin with the end in mind. So when you get into the business, right at the very beginning, get into the practice, is having a mindset about what the exit strategy looks like. So what does life look like beyond dentistry, beyond business? And then we can sort of put together a plan to take steps to get you there. It's almost like going on a journey, like with a sat nav. So we're sort of guiding you all the way through. Obviously things change as you go through that. So the budget changes with entrepreneurs relief or dentistry itself, the market itself. So the most successful exit strategies and dentists we work with are those people that definitely have that forward thinking mindset, so we can work alongside them and guide them through the whole process from start to finish. Yeah,
and I'm guessing that could sort of tell us nicely into terms of when you look at the investment market and when you look at money that's in funds is, often it is a long-term game, isn't it? And I suppose that does quite nicely into that. But if you look at how the market, obviously the market's been up and down quite a lot over the last 24 months for the most obvious reasons. I mean, how is the market looking at the moment, and how, what does it look like in a post-pandemic, I suppose, situation? Where is it up to at the moment?
Well, that's a really interesting point at the moment, isn't it? Because volatility seems to have led the way, but volatility certainly isn't a new invention. I mean, it's been around since day one in the stock market. But I think the key factors are sort of three sort of simple principles: is having the clear goal, so where we're heading for, then having a spread of assets so that that all assets don't go in the same direction. So if we find that stocks and go up, then bonds tend to go down and vice versa. So if we can get those two together to uncorrelate, then you get the best of all. You're kind of hedging your bets really. And thirdly, having discipline, so staying the course, actually staying on the plan. But I think going back to volatility, obviously it's in focus at the moment because that's where we are. But when you look back throughout history, the volatility we've had through 2008, 2087 stock market crash, 1926, all the way through, there's always been volatility. But when you look backwards, it's a tiny blip on a scale, whereas today it feels like it's almost like being on a plane and you get turbulence and you get a bit worried about it, but you're still going to the same destination. So some interesting numbers on volatility.
Are you flying then, Paul? You don't like flying, do you?
No, not a fan.
not a fan of flying. No. But so this is the thing I always say to clients, what do you do when you get turbulence? Do you jump out of the plane or do you carry on and tighten the seatbelt? So what we're doing is tightening the seatbelt by moving into funds that are not as risky or as correlated with the ups and downs. So the interesting thing, if you go back to 1926, if you had 100% of your money in stocks and shares over that period of time to today, you'd have averaged 10.3% per annum net. The problem is that the lowest it could have gone down by is 43%, and the highest it would have gone up by is 54% in a single year. So that's a roller coaster.
Yeah.
If we go to the other side of the scale and we go 100% bonds, then the average return would have been 5.3% per annum, so lower obviously. But the biggest loss in history is 8%, and the highest in a 1 year is 26%. Interestingly, if you bring those two together and get in the middle, so 50% bonds, 50% stocks, then we get to a point where the average growth rate is 8.8%, but the biggest 8.3%, but the biggest loss is only now 20%. So it just hedges the whole sort of investment return and avoids, if you're a nervous flyer, you avoid that kind of roller coaster ride.
Yeah, you go for a more balanced balanced market.
Yeah, definitely. And I suppose it also ties into the last bit, is the discipline of staying the course. So I mean, these stats are kind of unbelievable, but again, if you think, so if you invested say 100k in the FTSE All Share over a 20-year period, then you look 20 years down the road, your 100k is worth 256,000 if you just left it. If you came in and out of the market and missed just the best 10 days, that return goes from 256,000 to 139,000. And it's hard to believe those numbers. But it shows that some of the kind of upswings and downswings are concentrated in such a short period of time. And so it's impossible to time the market. So our phrase is, it's time in the market. It's not timing the market. But it all goes back to, what's my goal? What do I want to do in the future? What do I want to do beyond business? And how do we tie that in? What's your magic number? How much money do you need to do the things you want to do for the rest of your life without having to worry about going back to basically working, going back to business if you don't want to? So that's what we do in a nutshell.
Just anecdotally, because we've only got about a minute or so left, is that how have sort of people weathered the last sort of 18 months or so in the markets? Are you finding most people's pensions have gone down, or actually because there has been that volatility with the right fund, actually a lot of people are now up on where they were sort of 18 months ago?
Well, again, that's a brilliant question. It's really interesting. So the investor psychology is a bit crazy. People are fearful when it goes down and they're greedy when it goes up, and it should be the other way around. So the interesting thing, the FTSE last year was down about 10%. The majority of the portfolios we operate were up about 5%. So at the end of 2020, if you'd have started in February and said, we're going to be positive at the end of the year, it'd be hard to believe, but that's actually where they ended up. So long as they stayed the course, they ended up at the end of the year by about 5% on average.
Great. All right. Well, thank you for joining us. So if people want to know more, where can they find you?
So Holleron Wealth Management, obviously on the website, they can sort of go on there. We've got a Facebook page, we've got a LinkedIn page, Instagram, so they can Google us, obviously contact us at the office. We've got a team of people dedicated to working with dentists and business owners. So, pick up the phone, email us, holleronwm@sjpp.co.uk.
Great.
Well, thanks, Kevin.
Thanks.